Prior to joining Cboe, I spent probably about 18 years in the sell-side banks, covering large institutions, asset managers. And it was that unique experience that allowed me to gain a better understanding of client demands, how they wanted to approach the marketplace, in a sense, the B2C model, and how they were considering deploying capital and risk and approaching their risk metrics in the capital markets. It was really put in a unique perspective on how I think about approaching our customers. Those are our exchange members, and how they think about their customers' pain points, how they want to deploy capital in the derivatives marketplace, and what challenges they might have. And that is now taking a perspective on the B2B2C model, which we have, we can create unique partnerships on the B2B side, because one, I understand the position they sit in, and now I understand the position an exchange sits in. And from there, those partnerships really allow us to satisfy the customer demands. And what really it has transpired is solving customer demands hasn't changed, just my vantage point has by sitting at an exchange rather than at a sell-side bank. Customer demands have really continued to evolve as their use of US listed derivatives has continued to increase. It's been phenomenal, super exciting. We're the cool kids now at the table, which is great. And we see demands concentrated in three different areas: access, efficiencies, and functionality. It tends to be areas where they kind of have their pain points. From an access perspective, we've done a wonderful job listening to hearing them say, we want to access the markets all the time. We want to access the markets 24/7. We want to access the markets because news doesn't stop just when the regular trading session ends. So therefore, we expanded our trading hours. We added Curb last week. We expanded overnight with two of our largest proprietary products, SPX and VIX. And that started to satisfy the needs. They could be more nimbler about their risk management while also trading around those geopolitical events that we've seen all too frequently of late. Then moving on from an efficiency perspective, similar themes, but they have a responsibility and a thought process on how they want to manage their risk. They need to be more precise. So what does that mean? You have to be more thoughtful about the products that you offer to them. We've been able to release certain products that say that were maybe a smaller contract or a flexible contract, or just recently in our SPX complex, we added Tuesdays and tomorrow, Thursdays, expiries that says, that allows them to manage the risk, but also on a day that maybe historically had not had listed option contracts. And those are satisfying customer demands. Those demands that come from large institutional investors that might have said, I need to roll a position more frequently. I need to be more precise with my hedge. And rather than having to use the Wednesday contract, I can now use the Tuesday contract. There's more precision there. And then lastly, functionality. Like it says, what it makes it easier for them to execute a contract in the marketplace by having more efficient tools. A couple in particular, one, we have flex options, which is an ability for them to create a contract, a little bit more custom contract, but they wanted the ability to be able to trade that into the close, off the closing price. So we created a delta adjust on close functionality that allowed them to do that, to get the price of the close and represent it at the option price. And then lastly, going live on early in June 6th in particular, our new trading floor, state-of-the-art trading floor. You've represented it before for us. And it's that types of demands, needs as our floor continues to grow in terms of demand, the more liquidity providers want to be on there, and we need to improve and enhance our technologies. We're super excited about that go live. Let's break it into two different customer buckets. One, the institutional customer bucket, and then the loud and proud retail customer base that we're seeing in the listed option marketplace. But when I look at the institutional customer base, they really continue to utilize this US listed options market very nimbly, as precision, and they continue to use it in a very thoughtful way. Historically, they had approached the marketplace from an exchange perspective in block trading capacities, large asset manager-like sizes, large notional, and they might be looking for large capital liquidity providers to commit capital for those trades. But what's evolved is, those trades still exist, but what's evolved is that they've started to be more nimble with using electronic tools. And electronic tools are becoming more sophisticated. They've been asking for more low latency type of connectivity. They might be looking for more sophisticated algorithms, for the ability for them to be more thoughtful around their cost per contract on exchange. And by doing it electronically, that's been able to drive their costs lower and lower. So that's how the institutions have really approached the marketplace. Then you look at the retail marketplace. They've been really, clearly there's been a lot of news, you've published it yourself, on how and what they're trading in the marketplace. They tend to be very specific in terms of what kind of contracts they're trading. Maybe they're trading call options just to start, starting to trade a little bit of spread flow, and you're seeing the growth and the comfort and the utilization of an option product grow and grow and grow. But you see that, and that's represented in a lot of the volumes. They primarily have been focused on meme names, single stock equity names, and as their excitement and comfort level with US listed options has grown, last year I think on average it was like 26 million contracts of ADV was in single stock equity options. But this year, as we've seen the volatility, and I think that's the second part of your question, is we've seen them reduce their focus on single stock equity options, only averaging 23 million contracts per day. So you can see that they've waned in terms of what they're trading. And then you throw the market environment on top of it. Clearly extremely volatile, very challenging for anyone to drive to trade. The most sophisticated and or the newest investor in the marketplace definitely can struggle in this marketplace because there's a lot of uncertainty and then on where the direction of the market is going and where the bottom might be. So what has happened from a retail perspective is you've seen them kind of evolve from single stock equities, and they're definitely focused on ETFs and indexed option trading. Their volumes haven't waned slightly, but they're still participating aggressively in the marketplace, but less so in a very specific targeted fundamental equity positions, but they're more focused on hedging or maybe looking on the downside to play moves or protect their portfolio to the downside. Obviously coming up with a lot of innovation to start the year, 24/5, curb trading, adding Tuesdays and Thursdays, already a lot of innovation out there. We don't want to flood the market too much, but two areas that we're really focused on that benefit the investor is capital efficiencies. We continue to be focused on our initiatives, advocacy with the regulators, with OCC, with other exchanges in order to address the portfolio margining concerns from a customer perspective and risk metrics that cause probably an inability for all participants to be able to participate in the marketplace as much as they might want to. So making it more efficient from a portfolio margining perspective with offsets is clearly a topic we've talked about many, many years, and we do think that we're starting to see some of the appetite to change those rules come to fruition as we look at this year. I think the other areas where you might see us start to announce some new functionality is on our future side. We have one area where we might have a functionality gap is options on futures. We have a lot of customers, especially in the CTA and institutional realm, that really would like to use optionality alongside their futures positions. And that's a product that we've never offered. So we've made steps right now to start to build that functionality and expect it will be live by the beginning of 2023.